and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, October 20th, and I'm recording this from our headquarters at 1585 Broadway in New York. Over roughly the past 6 months, the S&P 500 has surged 34%, one of the biggest gains outside of a recessionary recovery in the past 75 years. As impressive as that is, it trails the eye-popping gains in the highest beta parts of the equity market, namely small caps, which are up 39%, micro caps, which are up 57%, and unprofitable technology firms that are up more than 70%. When we also take into account the outperformance of cyclical stocks over defensives, it appears that investors are positioned for a reacceleration in the economy in 2026, and one that will extend well beyond the AI ecosystem and into the real economy. This expectation of economic broadening is embedded in ambitious profit forecasts. We also see it in the stunning outperformance of high beta and momentum factors over quality factors at an 8,000 basis point spread year to date. The case for a broadening economy has some potent ingredients, for sure. Fed rate cuts, corporate tax cuts next year, and coming deregulation in the financial sector. Still, we're not convinced that the economy will lift all boats enough to generate positive profit surprises and justify current high valuations. We see the economic backdrop remaining complex, with looming tariff and trade risks, labor market imbalances, currency volatility, and idiosyncratic deal-making in Washington still being factors. These underscore the advantages of size, scale, and pricing power, factors not enjoyed by smaller cap names. As we see it, smaller companies will face at least 3 major obstacles in 2026. First, the data suggests that more than 1/3 of the Russell 2000 cohort continues to remain unprofitable, even with nominal GDP currently averaging more than 6% and running roughly 50% above the 20-year norm. Second, small companies' cost of capital at around 7% remains well above the return on assets, which is less than 2% currently. It is also at least 250 basis points higher than that of large company competitors, a gap that is meaningfully above average. High-yield credit default swaps have widened over this past month, and we're watching for signs of credit stress that may not be easily cured by upcoming Fed rate cuts. Finally, the steepening of the yield curve has historically been correlated with large cap companies outperforming small caps. We expect that curve steepening to persist next year as concerns over U.S. debt sustainability and other structural issues continue to put upward pressure on long-duration term premiums. Despite the allure of momentum, we believe now is not the time to lean into speculation and low quality. Ultimately, the broadening of the U.S. economic boom thesis that includes small, medium-sized, and credit-challenged companies may disappoint in our view. That, in turn, may result in a rotation back to quality and strong fundamentals favoring big over small once again. In fact, last week, the Global Investment Committee increased our allocation to U.S. large-cap companies, putting us at a 300 basis point overweight to our benchmark in our key models. Consider taking profits in high beta, small, and micro caps, as well as speculative and unprofitable equities, and redeploying that to large cap core and quality stocks, including the Mag 7 and companies in financials, healthcare, and energy that stand to benefit from generative AI. Our S&P 500 target price for 2026 is 7,200. In fixed income, we suggest shifting up in duration into the 5 to 10 year belly of the curve to clip coupons, while continuing to focus on asset class diversification. International equities, real assets such as gold, real estate, and select private infrastructure are our favorite opportunities for current additions. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.